How on earth does a company secure the single most impressive AI backlog in the entire world and immediately get slapped with a near-junk credit rating? That is the multi-billion-dollar tension currently tearing Oracle apart, because on paper, they've completely won the AI infrastructure lottery. But to actually fulfill that massive promise, they are burning through cash so aggressively that it's triggering alarms all across the credit markets. So we're going to dive into this insane valuation disconnect today, because what is happening inside Oracle right now is an absolute masterclass in the dangerous gap between a futuristic promise and present-day dilution.
To really wrap your head around the scale of this story, you just have to look at one staggering number: $638 billion. That is Oracle's remaining performance obligations, or RPO. It represents a massive 363% year-over-year explosion in contracted backlog. Now, theoretically, this kind of multi-year revenue visibility should literally be sending the stock to the moon. You've got the biggest AI customers in the world lining up around the block, practically begging for compute power.
But here is the brutal reality hiding right beneath that number. To actually fulfill that $638 billion promise, Oracle has to build the physical data centers. And doing so has required taking on so much debt that on July 9, 2026, S&P Global Ratings downgraded Oracle's credit rating to BBB-. For context, that is exactly one notch above junk status. So the central conflict we are looking at is this: Oracle is drowning in world-class demand, but the sheer amount of capital required to meet that demand might just break their entire balance sheet.
Now, let's give this some quick business context before we look at the financials. When we talk about cloud infrastructure, we usually talk about the big three. You know them. AWS leads the pack with about 29%, Azure sits at 20%, and Google Cloud holds roughly 13%. Meanwhile, Oracle holds just a tiny 2% market share. So you have to ask, how is a player this small suddenly capturing billions in top-tier AI contracts right out from under the hyperscalers?
Well, they win because they aren't trying to be the everything store of cloud computing. Oracle's specialized moat is something called OCI bare metal infrastructure. Unlike your standard cloud networks that run heavy virtualization software, which by the way eats up a lot of valuable processing power, Oracle leases non-virtualized physical GPU clusters. We are talking about massive, dedicated NVIDIA GB200 and AMD Instinct networks. By bypassing all that hypervisor overhead, Oracle can offer incredibly low latency and ridiculously high performance. And that is exactly what the world's biggest AI researchers need to train their next-generation models.
And this specialized focus brilliantly illustrates what is actually driving the business today. Now, Oracle is historically known for legacy software, but just look at their fiscal year 2026 cloud growth. Total cloud revenue is up a very healthy 39% to $34 billion. But the absolute rocket ship inside that number is infrastructure as a service, or IaaS, which was up a staggering 77% for the year. This bare metal compute engine we just talked about, that is the fundamental catalyst behind their top-line momentum.
But Oracle isn't just winning in AI hardware. They are aggressively defending their legacy database empire too. Migrating a massive enterprise database away from Oracle is a total technical nightmare for a company. It's incredibly sticky. So Oracle executed this brilliant strategic pivot called the Multicloud moat. Basically, they struck deals to run Oracle databases natively inside their competitors' clouds: Azure, Google, AWS. By doing this, they eliminated the friction for their customers, effectively turning their biggest cloud rivals into distribution channels for Oracle's own highest margin products. It's a genius move to expand their total addressable market.
And by the way, if you like deep, evidence-based stock breakdowns like this, you'll probably want to make sure you're subscribed. All right, let's pivot to the central conflict, because this right here is what the market is truly terrified of. On one side of the ledger, you have unprecedented, historic AI demand. But on the exact opposite side, you have a crushing capital drag. To build these AI clusters, Oracle's total debt has ballooned to $156.2 billion. Capital expenditures hit a staggering $55.7 billion for the year, and that resulted in deeply negative free cash flows. We're talking negative $23.7 billion. They are quite literally spending money faster than they can print it just to keep up.
But honestly, the debt load isn't even the scariest part of the bear case. It's the structural duration mismatch. See, Oracle is signing non-cancelable 19-year leases for these massive data centers. Meanwhile, the AI customers buying the compute space inside those centers are often only signing 5-year contracts. Think about that math. If AI demand cools off in year 6, Oracle is still on the hook for another 14 years of massive lease payments, and they'll be staring at empty servers.
We actually saw this exact tension play out vividly in their latest earnings report on June 10, 2026. Looking at the Q4 fiscal 2026 statement, total revenues beat Wall Street consensus, hitting $19.18 billion, up 21%. That cloud IaaS segment, it surged 93% in the quarter. Insane growth. Non-GAAP earnings per share came in at a solid $2.03, excluding some one-time investment gains. But crucially, look at the bottom line here. Interest expense spiked 47% to $1.44 billion just for the quarter. The cost of carrying all that debt is eating directly into their operating margins.
Now, to be fair, management strongly pushes back against this debt panic. Co-CEO Clay Maggiork noted on the earnings call that they signed $67 billion in new AI infrastructure contracts in just one single quarter. But more importantly, he highlighted that customer cash prepayments now total $75 billion. So Oracle's argument here is that they are using these massive upfront customer cash injections to offset the net capital they actually have to raise to build the data centers. It's essentially customer-funded CapEx.
Synthesizing all of this into a qualitative scorecard, we see a business with a severe split personality. Analyst sentiment is incredibly high at a 9 out of 10, with Wall Street setting price targets well over $260. The growth outlook is a robust 8 out of 10, completely backed by that RPO backlog. But financial health and capital allocation both sit at a highly concerning 4 out of 10. And here's the kicker. To fund the next phase, Oracle is planning a highly dilutive $40 billion capital raise in fiscal 2027. They are aggressively prioritizing AI market capture over immediate balance sheet stability.
And there's another note of caution we have to talk about regarding management alignment. While founder Larry Ellison does maintain a massive stake, there has been substantial executive insider selling right during these peak AI valuation periods. In fact, a recent class action lawsuit alleges executives dumped $1.87 billion in shares right before a recent 15% valuation decline. Listen, when insiders sell heavily while simultaneously asking public markets to absorb a massive, dilutive equity raise, it absolutely warrants investor scrutiny.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch to monitor your holdings and Insider IQ to track meaningful insider buying activity globally. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, getting back into it. Before we look at the next 5 years, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios.
Let's break down the 5-year scenario sizing matrix, starting from Oracle's current price of $126.41. When we probability weight these operational paths, the model yields a blended target price of $197.92, which implies roughly a 56% total return over the next 5 years. Now, the high case gives us an implied price of $354, representing a massive 180% return if everything goes perfectly. The base case points to a solid $203, but you have to pay attention to the low case here. It's severe, dropping to roughly $60 a share, which would effectively cut the current valuation in half.
So what actually has to happen to achieve those high-end base cases? Well, Oracle has to execute flawlessly. The core operational assumption is that the $638 billion backlog converts rapidly into high-margin cash flow. On the balance sheet side, those billions in customer prepayments must successfully offset the need for painful equity dilution. If they can successfully build out the data centers on time, drop their debt leverage below 3x, and generate real positive free cash flow, the market will confidently award them a premium 22x PE multiple.
But the low case outlines a very grim operational reality. If a major AI customer defaults, Oracle is left holding the bag on empty servers. If regulatory gridlock severely delays data center construction, those customer contracts can't actually turn into recognized revenue. To survive those high fixed costs, Oracle would be forced into massive at-the-market equity offerings, blowing up the share count. Earnings would compress, the credit rating slips below investment grade entirely, and the market crashes the multiple down to a highly defensive 12x. And that brings us directly to the risk analysis, because this is where the thesis could actually break. Oracle's biggest risk right now is counterparty concentration. Credit analysts estimate that roughly half of that massive $638 billion backlog belongs to a single company, OpenAI. Think about that. OpenAI is a private, highly leveraged venture burning billions of dollars to train models. If their funding slows down, or if the broader AI venture bubble pops, half of Oracle's vaunted backlog is instantly at risk of vanishing.
And even if the customers have the cash to pay, Oracle still has to actually build the buildings, and they are facing severe permitting bottlenecks. In New Mexico, the state just rejected a 17-mile natural gas pipeline that was meant to power a massive 2.5-gigawatt data center campus. Meanwhile, in Wisconsin, regulators are suddenly demanding a multi-billion-dollar letter of credit to protect taxpayers before Oracle can even build its $15 billion lighthouse campus. So capital expenditures are rising, but physical capacity delivery is stalling out.
And on a macro level, the whole regulatory environment is shifting entirely. In July 2026, UK financial regulators officially designated cloud providers like Oracle, AWS, and Google as critical third parties. This means they are now subject to direct, bank-style resilient supervision. The era of unregulated, frictionless cloud expansion is basically over, adding yet another heavy layer of compliance and operational costs to the model.
So let's bring this all together with the three most critical takeaways you need to remember. First, this $638 billion AI backlog is real, and it offers unparalleled multi-year revenue visibility. Second, the $156 billion in debt and massive CapEx requirements create extreme capital risk, which is exactly why we saw that near junk credit downgrade. And third, if a major counterparty fails, that 19-year duration mismatch on their data center leases will become an absolute financial nightmare.
Which leaves us with the ultimate tension defining Oracle right now. They have arguably the most specialized, high-performance AI infrastructure on the planet, but they are completely mortgaging their balance sheet to build it. Will Oracle's incredible $638 billion AI bet mint cash before the debt comes due, or will the cost of the future crush their present-day equity? That is the exact question every single investor must watch next.
If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.